Investors are watching developments at the Fed closely, but they're also waiting for the Fed's preferred measure of inflation, the PCE report, due on Friday. Here to talk about rates and the Fed is Komal Sri-Kumar, president of Sri-Kumar Global Strategies. Sri, thank you very much for being here.
Good to be here, Leslie.
So we were just talking earlier in the hour about kind of the relatively muted response in the markets relative to just the historical notion of what we're seeing play out at the Fed. Maybe a little bit higher term premium on the long end of the yield curve, but otherwise, limited market reaction. Do you think that changes as the question over whether the president can fire Lisa Cook works its way through the court system? And at what point do you think the markets ultimately react, if at all, to this?
The market reaction so far, Leslie, has been affected by two factors. First of all, the corporate earnings numbers have been good, and that has kept up the equity market. And secondly, the markets are looking for lower short-term rates, the federal funds rate to go down, thinking that that is going to be positive for risk assets. What is going to change with time, and it typically happens suddenly. In other words, the bond yields shoot up when they shoot up. And when they do, I wouldn't be surprised to see a single week with the 10-year yield up 25 basis points or higher. Why? Because the yield curve is going to steepen. As the 2-year yield goes down, the 10-year and 30-year yield eventually will go up. Is there a historical precedent? Look at September to December of 2024. 1 percentage points cumulative decline in the federal funds rate from September 18th through the end of the year, and the 10-year yield increased by 90 basis points during the same time period. It's going to be even worse today. So if the presidential firing of Lisa Cook does not survive, if that is not allowed by the Supreme Court, the markets will take over and they will make sure that this whole situation fails.
I just want to follow up on that.
This whole situation fails. What do you mean by that?
Fails meaning, Andrew, that you have the long-term yield go up, therefore the debt servicing cost increases rather than go down as the president wants. If you want to get a mortgage to buy a home, your mortgage rate is going to be much higher, and so the economy suffers. The question is, how does the economy suffer, through the courts or through the market? And I'm saying, and I've been saying for quite a while, this tells me that we are moving toward a stagflation, a situation when you have a recession, at the same time inflation picking up significantly. And recall that the last time it happened was 50 years ago during the Richard Nixon presidency, not since. It is a rare event, but we have all of the various factors which say to me that we are proceeding toward it. What can prevent it? Change the policy. Immediately go back and allowing the Fed to be independent, but we don't see any prospect of that happening.
Can you explain, just for viewers who are waking up as well, because there's this conventional notion that if you decrease the Fed funds rates, the market rates will follow. But in this scenario, there's obviously a clear gap and the potential for that to even widen in the future. Can you explain to our viewers why that is relative to just confidence over the Fed's willingness and appetite to fight inflation, the credibility element of it?
Great question, Leslie. This is how it happens. If the markets believe that a reduction in the federal funds rate is justified by inflation expectations, consumer sentiment, then the long yield also follows the short yield, and the yield curve either flattens or it remains the same. But if the markets believe, that is to say, eventually if the investors believe that high inflation expectations do not justify the Fed going easy on policy, the markets take over. And that is what happened when Jerome Powell made that serious mistake in September of last year of cutting the interest rates by 50 basis points. The markets did not think that was necessary. I thought it was politically motivated. It was 7 weeks before the elections. There was already no love lost between Trump and Powell. And he clearly had his interest in cutting the rate by 50 basis points. There was no economic reasoning. The market said you should not have cut rates, therefore the 10-year yield is going to go up. That's when you have a distinction between the short and the long. if the inflation expectations don't justify your cutting.
So Sri, what could be the trigger for suddenly longer rates going up? Could it be something develops on the Lisa Cook issue? Could it be, in fact, in September, based on the speech last week, that we do see a 25 basis point cut in September? Would either of those things be the trigger to see long yields gap up?
There are 2 or 3 events which could trigger it, Wilfred. Starting first, if Lisa Cook is in fact fired, if that is allowed and she leaves, and the president puts in another person who follows his dictate to cut interest rates, that could do it, because you're going to have 3 or 4 dissents from Jerome Powell. The last time we had 3 dissents or more was 1987. So this is a very, very rare event. Even to have 2 dissents was 1993 that it happened last. So that is one way in which it happens. Second, Friday we are expecting the PCE inflation year on year to go up from 2.8 to 2.9%. Suppose the markets were too optimistic. It comes out at 3.1%. Then again, the yields shoot up. And if in the aftermath of that, the Fed still cuts, you're going to have the long yield continuing to go up and stay higher. And the third one, if the president actually stacks up the Fed with his nominees, and there are indications that some of the regional bank presidents can also be changed, then the independence of the Fed has completely come to an end. It doesn't matter, because the president can nominate you or take you off as he sees fit. That again can cause it. When we are now approaching the beginning of September, I would say any time between September and the end of the year is when it happens. That's my timing.